Hi and welcome to the JMI Wealth monthly video series. It's early July now as we're recording this, and we're halfway through the year, and I'm happy to be able to report, or I'm comfortable to be able to report, that those strong returns that we'd seen in share markets or equity markets we've seen a continuation of those right through the month of June. So the S&P 500, the main index for the US market, is up 8.8% for the quarter ended the 30th of June, which is still, as we say, pretty strong returns. The ASX 200, the Australian market, is up 7%. The Poor NZX 50, though, our local market, is still underperforming a little bit, only up 0.7 for the quarter, although I do note that in the month of June it was up 2.7%, so it's encouraging to see it lift towards the end of the quarter. But we're going to cover off a few things today. Front and centre, I want to talk about the progress we're seeing in vaccinations around the world. I want to talk a little bit about employment, about jobs, key part of the recovery that we're seeing. But the key theme for today is inflation. I want to delve a little bit into inflation a little bit and talk about why we're seeing it and what the implications are for that inflationary impulse that we're seeing in a lot of jurisdictions right now. So let's talk a little bit about vaccination progress around the world. And vaccinations really are the key to us returning to sort of a normal economic environment and allowing the world to move back to some degree of normalcy, though I'm not sure whether we'll ever be quite where we were. So we're starting to see vaccination, the level of vaccination, increase in a number of jurisdictions around the world. A number of countries have now vaccinated at least half of the population, or they've got half of the population have at least got a single dose of one of the various vaccines. So places like North America, Canada, the US, the European Union collectively has now given at least one vaccination to half the population. So we're seeing good numbers in places like France and Italy and Germany. We're falling a little bit behind the marker here in New Zealand, but Australia is getting there as well. And the thing about the vaccinations is it gives people confidence. It gives people confidence to move around, and it gives us the opportunity to get back in to that degree of economic normality. And the other topic I wanted to touch on at the moment is employment, because as we move from this sort of transition, I suppose, from recovering from COVID to actually trying to expand our economies, the jobs market, the employment market is pretty important. And it was that market that was hit really hard by that economic interruption that we saw through COVID in the first half of 2020. So we're starting to see quite marked jobs recovery, and in fact we saw what's called the non-farm payrolls number. That's like the monthly employment report in the US. For June, that was a lot higher than expected. So the US economy added over 800,000 jobs in the month of June. And this brings us to the main topic that I want to talk about today, and that's inflation, because the rubber's really starting to hit the road now on inflation. And we're starting to see this all the way around the world. And actually, the interesting thing about the inflation that we're seeing is it's what you get when you get the enormous amount of fiscal and monetary policy stimulus that's been thrown at various economies. But the situation is complicated by some other factors that are pretty unique to the COVID, I suppose, experience. We're seeing supply constraints around the world. We're seeing those supply chain issues. We're seeing the wage issues that I talked about, employment issues, and all of this is building up to inflationary pressures across a number of sectors of the economy. And if I look at the US economy, they've just released their consumer price index, and that number came in at 5%, an annualized number of 5%, which is massive. And that's the highest inflationary number they've seen in the US since 2008. And it's a domestic issue as well. We're starting to see these inflation pressures creep through in New Zealand too. And we have the quarterly survey of business opinion, which is issued by the New Zealand Institute of Economic Research. And right through that survey, we can see evidence of these inflationary pressures. Something like 39% of businesses who responded to that survey raised their prices in the last quarter, and 52% are intending to raise their prices in the upcoming quarters. These are numbers that we haven't seen for decades, and we're seeing these pressures in the labour market as well, where in New Zealand at the moment we have the tightest labour market as per that QSBO survey since, well, for decades really. I think in a number of areas we haven't seen the labour market this tight since the 1970s. Yeah, so what does it mean we've got inflation running hot like this? Well, one of the first things you start to see is a phenomenon called negative real interest rates. And this is where those interest rates that people can say put money away in term deposits for is actually lower than where the rate of inflation is, which is a real disincentive for people to save. Some of the other questions that we have about this inflation as well is whether or not it's going to be transitory, whether or not it's going to be persistent. And that, at the moment, that question remains to be answered. But the third issue is, what do the central banks do about it? Does it bring the central banks into play? What this means is that they may have to adjust the monetary policy settings. There's a number of ways they can do this. They can reduce some of the, what we call the quantitative easing measures that have been put in place, buying bonds back off the market, but they can also increase the official cash rates. And we're starting to see lots of calls now for the Reserve Bank of New Zealand to raise the official cash rate. We still believe conditions are conducive for equity markets to perform well. Look, the normalisation of interest rates is inevitable at some stage because the central banks threw so much monetary policy stimulus at markets. It's not so much that interest rates need to normalise, it's really the manner in which that occurs we think is important. As long as it occurs in a fairly orderly fashion, and as long as the central banks communicate well what they are doing and why they are doing it, we don't believe this will be disruptive to equity markets. However, if we start to see interest rate rises in a chaotic, in a disorderly fashion, that could create some volatility for share markets. So in terms of general portfolio positioning, we remain structurally overweight to growth assets, particularly local shares and global shares, and we remain underweight exposure to those fixed income assets where that reflects our view that interest rates probably still need to go up a little bit. And on that note, well, I look forward to talking to you again next month. If you do need help with an existing investment portfolio, or you have some cash that you're thinking you'd like to invest into a portfolio of financial assets, we'd love to hear from you. Give us a call, or you can look us up on www.jmiwealth.co.nz.